Hey everybody, this is Patrick from Infinity. Thanks for taking a look at the video here today. We're going to talk briefly about the Russell. The Russell is back. It has moved over to the CME and it's gaining a lot of traction since the rollover, which really completes this week tomorrow with expiration of the September contract. And I just want to highlight a couple things briefly here about what we're looking at. So obviously this is the standout chart on the right, the one in blue. On the left we've got the S&P, in the middle there the Dow, and then the NASDAQ, and then the Russell. So there's two studies on the chart. The one is the ADR in dollars. That's the average daily range in dollars. I believe we're looking at a 20 period look back here. 20 periods, yep, look back, or 20 days. And then we've got the volume. So the obvious thing here is the volume is extremely high ever since rollover. So the volume is really coming back. It's trading more than the Dow futures are, which is great to see. It's a small cap stock index, so it's going to be a little bit more volatile, but with the cutback of the Russell from $100 a point to a $50 point, the contract is a little bit muted. And what I mean by that is that a lot of people wanted to trade the Russell before when it was $100 a point, and they couldn't afford it because they'd have to use too wide of stops in order to have a chance to win. And they couldn't afford to do that. So we were originally a little frustrated with the contract size coming back down to half of what it was. So every tick now in the Russell's $5. There's 10 ticks to the point, so every full point is $50. We were a little frustrated with that at first. A lot of our clients felt the same way, but given that most people tend to over-lever a little bit, if they get out of control, it doesn't work out well. This is maybe not a bad thing. And so I really would invite people who may be on the sidelines from the NASDAQ or the S&P due to those larger values, contract sizes, larger average daily ranges in terms of dollars, especially those people trading the NASDAQ. If you want something that is showing itself to be a little bit more muted in terms of average daily range, you might want to look at the Russell futures. The symbol's RTY. Same fees and everything as the CME, even the S&P and the NASDAQ. You don't have to add another data fee if you're already getting the S&P and the NASDAQ. So it's a market that's definitely gaining some traction. It traded over 250,000 contracts the other day. That was awesome. So this contract is back in business. It's back into the fold. People are starting to watch it. Our clients are starting to trade it. We're doing a good amount of trading in it every day. And we highly recommend that if you've let this fall by the wayside, if you're looking for something that doesn't have the same expense associated with it in terms of daily ranges in dollars as the NASDAQ, for example, which is really up there right now due to all the volatility in the tech stocks, maybe take a look at the RTY. All right, so hopefully that helps out. Let us know if you have any questions. If you want a copy of the chart file here for your reference, just contact your rep in our office. We'll get it over to you. Thank you.